or on LinkedIn. And then we have YouTube Live. And I know it's been a while since we've done a live. I had to do a tech check before I got on. It wasn't reading picking up my audio, but super glad to be back. Just been a busy summer, I guess. Lots going on. And we have Randy the lender here
Randy the
with
Flender.
Randy the lender. Um, and River, like the software that we use has changed a lot. So um, just kind of getting familiar again with everything. And a lot has happened. We know that the market has been crazy. Do you want to do a quick update like on interest rates and how things are going with that?
I mean, they're going. Interest rates still are, I guess, they're on the higher side of what people want to see. They haven't done the drastic drop that everybody was hoping for quite yet. It's still on the forefront, though. I think everyone's still anticipating that they're going to be dropping. Hopefully, towards more the end of the year, maybe beginning of first quarter next year. But again, who knows what's going to happen? It's always ever changing every day.
Yeah, yeah. And I feel like a lot of the political stuff has a huge impact on whether buyers feel comfortable buying or not.
Mm-hmm.
I know that I'm a military relocation specialist, so I work with a lot of military buyers, and they're just nervous about, their jobs with all the cuts and the funding and everything. So it's really a tough time. And we can see comments. So if you guys have questions or want to uh, submit comments or questions, we can do that here in the chat. So let me just make sure. There we go. All right. So sales are really, really low. I did a video recently, at least in Colorado Springs specifically, that this has been like the lowest year that we've had for sales in like over 10 years, at least 10 years. And summer, should be a time where people are buying. It's convenient to move during the summer. And then, but yeah, I want to say it was like less than 800 sales in the month of June. But I'll link that video below so you can go back and watch it and see what the latest stats that I pulled were doing. I don't do them every week. I try to do them at least once a month because not much really changes. There's a lot of headlines that will say, the market's doing this and that, whatever. But some of it is true. Some of it only applies to certain markets. And then obviously, your local market's going to be different than what the national people are saying. Because in Springs, the average home price is actually higher, which is interesting because there's a lot more inventory on the market. And so you would think that the prices would go down, but it's kind of going up. And I read a stat the other day that half of the inventory homes for sale on the market, if they're not selling, then half of them are basically coming off of the market. So that doesn't help either when people are just going to, it's like a lot of sellers are just testing the waters to see if their house will sell. And then when it doesn't, after 6 months or so, they're just renting it out or pulling it back off and changing their plans. So it's not really making prices go down.
So have you noticed a lot of price decreases, or you feel, like the purchase prices are starting out high and then they're decreasing?
Mm-hmm.
And then with the relocation, are they having a hard time selling? Like, what are they doing if they have to
Yeah.
PCS out of Colorado Springs or into Colorado Springs with the higher prices and things not moving as fast?
Yeah, that's a tough one. People are taking a huge loss because so if you bought in 2022, 23, those houses are in negative equity. Not a ton, but it's like people can't afford to sell it with all the fees, with all, paying their realtors and everything like that. They're kind of underwater on that.
Wow.
But yeah, so they're taking a huge loss, or they're, it sucks because we are a military town, And so a lot of these listings, especially in Lorson Ranch, you've got all these listings that are just stacking. And, I'm showing homes and I'm like, this is a great house. Like, I don't understand why this house is sitting here. And people don't take advantage of doing things like assumable loans because they don't fully understand it. Um, are you seeing a lot of activity like in the assumables? I know you do, like, you don't do assumables, but
Well, no, we do assumables.
oh, you
Um,
do.
yeah, but
Good to know.
it just kind of depends on, I feel like a lot of the veterans, if they can find another veteran that wants to assume the home and they have that extra cash, but I feel like what I'm seeing is that they don't actually have that cash to bridge the gap. So for what they actually owe on it and what they can assume versus what the seller's trying to sell it for. I've seen that. And then also them just not wanting to keep their entitlement,
Yeah.
you know, like not freeing the entitlement and having someone who's not a veteran who can do a VA loan, because then that keeps their entitlement tied up and then they can't use it. So we don't really do that many. I feel like it is it could be a really good selling point, and it's a good thing that someone can get into, and you definitely can get into a very low interest rate. A lot of them are in the twos and threes. And
You guys, do you do secondary financing?
no, so they would have to come up. They would have to have the cash in order to. They can't do another loan on it.
So they
To
can't do, like, say like they qualify for 500,000, but the gap is, it's very, like the one that I have, the gap is like 40, 50,000, and it's I mean, it's a great house, but so coming up with that difference, they can't get it elsewhere, or, and it's like, no.
Yeah, no, they can't. Yeah, they can't. They can't get another first mortgage on
Can they
it.
have it gifted? Like, say like mom's gonna.
Yeah, I mean, yeah, if they can get the cash for it, then they're golden. If they're able to do that, they just wouldn't be able to get another loan on it.
Okay, gotcha.
Yeah, so they would just strictly be assuming the first mortgage from the
Okay.
veteran. Yeah.
um So I didn't mean to interrupt you, but you were saying, you were going on about the something else before that, before we move on to the next thing.
I don't know.
I made you forget.
It
Okay.
might, it might come back to me. Who knows?
Okay. We're just kind of going off the cuff here. So do you want to just jump in what we were going to talk about today? Is the ARM loans and what people are
Oh,
doing with ARM
yeah.
loans now.
So I've actually done more ARM loans the past year or two than I ever have before. I've never, beforehand, there wasn't really a market for it. I think a lot of people are immediately when they hear ARM loans, they panic because they
Mm-hmm.
think of all of the bad, all the negative press that they got because of the market crash in '08. But they're actually not as scary as people think. So they actually in this market, they give people more purchase power, more. They're able to get into homes easier. Their payments are lower, and then with the anticipation of rates going down, then you refinance out of it into a conventional FHA, whatever. That's a fixed product, but there's guidelines and rules now that there weren't in place before. So back in 2008, it was more like predatory lending, basically, is kind of the way I would describe it. People were in loans that they should never have been in. They were qualifying them on the very low interest rate, getting people into their dream home, essentially selling people on the dream, and then when the ARM loan came due, it ballooned, people couldn't afford it. Then the market they couldn't refinance, they couldn't get into it. So that's why a lot of people were foreclosing and short sales, and it just turned the market completely upside down. Well, after that, the government stepped in, they put in all these rules and regulations to prevent that from ever happening again. So now people have to qualify for the higher rate if it were to when it ballooned. There's caps on how far the interest rate can go up depending on which program you're going into or what lender has for their ARM programs. So you'd want to definitely look into that if if you decide to go forward with one. But there are procedures in place so that it protects people from getting into those really bad situations. But I mean, it's helped a lot of people get into houses, and a lot of people get into something that they can afford, while we're waiting for these rates to come down.
Yeah. Um, so do you have like kind of like a scenario that you could share where um, this worked out for one of your clients?
Yeah, so I have one right now, that just closed, that they were in kind of a unique situation. Him and his partner, they were selling both of their homes. One person didn't have favorable credit, the other had excellent credit, but they both had, really good income. But with only putting one person on the loan, it limited their buying power because they weren't able to purchase the home that they wanted with the current interest rates. So they were strapped with the cash. They were strapped with, or they had the cash. They just were strapped with their debt to income limits because we couldn't put one person on there because their credit wouldn't qualify them. So we were able to put them into an ARM loan where they had a fixed rate for 7 years. And it had, I think, it was in the fives rather than in the sixes. And it gave them just enough to actually get into the home that they needed to expand their family. So that helped out a lot. I've done a few first time home buyer ARM loans. Some first time home buyers, they have a hard time getting into the market. And I think, like what you were saying, the purchase prices are higher, so it costs more to get in. I don't think that the income and the wages have increased at the rate that home, everything else has increased. So it gets them into the house, and they're able to start building their wealth through real estate that way. And then again, like I said, we never really know what's going to happen, but with the anticipation of the rates coming down, then they'll be able to refinance and get out of it. And that's the main goal with those.
Yeah, I think a lot of people are afraid of that too. Like, so especially because people were saying, "Oh, you should buy back in 22 and then just refinance when rates drop," and that didn't work out for them. So I think a lot of people are just kind of
Yeah.
hesitant on that. So like what are some of well, first let's go back and say what type of person would be suitable for an ARM loan?
I mean, I don't think that there's someone that wouldn't be suitable for an ARM loan. I mean, there's even people who do qualify for the regular mortgages, but they still want to take advantage of the lower interest rates in those terms. Then, I mean, they're doing them too. So it's not just someone who needs to get into the house. It's just, they just want to save some money. They could save hundreds of dollars a month getting into those. So,
And then you don't have to go the full 7 years. You can refi like
mhm.
maybe year 3.
Yeah, and there's different terms too. So it just kind of depends on that person's unique scenario, because everyone's scenario is different. So it just depends on what their goals are. And there's some people who buy a house and they're not anticipating on even staying here for
Yeah.
5 years. So, I mean, they get a break on the payments, and then they're anticipating on selling. So there's many different ways that or reasons why you would want to get into it. But I wouldn't say, some people just are absolutely, they won't want to do it. But I think that, like I said, I've done a lot more recently for good reasons.
Yeah.
Yeah.
Um, because people are going to ask, what are some of the risks of doing an ARM loan?
Well, there is a chance that the rates don't go down, and then you would be stuck in the adjustable rate mortgage. But again, like I said, there's caps and there's rules and on how long, or how much the interest rate can go up and when it goes up. So for example, we have one that's a 7.6. What that means is it's fixed for 7 years, and then if you don't refinance out of it or sell the house or whatever, after those 7 years, then it'll adjust, and then it can adjust every 6 months after that, just depending on what the rates are and what's going on. So that is a risk. And I would say that that's probably like the biggest risk, is just like if they don't go down, and if you don't refinance or sell, then you would be in that adjustable rate. But again, we do qualify you on those higher
The
rates just
higher,
to make
yeah.
sure that you're able to qualify, if that were to happen. But that would be the biggest thing.
Yeah. So as long as your income, most people kind of advance in their career, but
Yeah.
obviously there are situations where, you know, someone loses a job or something
Hmm.
unfortunate happens. So I think a lot of people are just like hesitant with that. But I always think about the Warren Buffett's quote was like, when people are greedy, that's when you should be fearful. Like when the market
Yeah.
was hot and everyone was buying, that's when you should be cautious. And then now there's just so much
Well,
opportunity.
yeah, and I mean that's true for not even just an adjustable rate mortgage. That's true for any mortgage. Like you never know what's going
Hmm.
to happen. I
Yeah.
mean, even if you buy something and it's at the tip top of your budget, what happens if you do lose your job, or what happens if they close or something? I mean, it's a risk regardless. So
Yes.
I don't know.
Yeah.
I do think that there's a lot of opportunity out there, especially in Colorado Springs. Like you said, there's a lot on the market. There's a lot more negotiation power right now. And historically, summer's the time where we're super busy. And I feel like it's been hit or miss. We've been
Hmm.
kind of going up and down. It hasn't been a steady busy. So there are opportunities out there, and there's ways to, for you guys, if you have a good realtor like Iris, to negotiate and get you into something, and then get the right loan product, then I think that you can potentially have a really good deal on your hands.
Yeah. Yeah, I miss the days where you could just go buy a house. Cause it's funny, cause like we have sellers that they think it's still like a hot market. And
Yeah.
yes, our values are still holding pretty decent, but it's not. I don't know how long it takes for that news to get out to everybody that it's not a hot market, but it's like they're trying to sell and then buy at the same time. And um, I have a couple clients that are in that, but I mean, their homes are more expensive, so it does take longer to sell anyway. But it's just, but it is interesting and unique, good to see like which neighborhoods and which homes are going quickly. Like obviously, if it's priced right from the start, they say that the longer your house is on the market, the less of the closing price you'll get. So it's always good to start it off right the first time and not say, well, let's list high to see how things go. That's like the worst thing you can do. You're literally losing money when you do that. And I don't think a lot of sellers realize and understand that. And I've had one of those where it's like, and it was unfortunate because I'm like, he's a realtor too, like in another state, but I'm like, you should understand this. And pricing it too high, and then that first week or 2 3 weeks,
Yeah.
if you're not under contract, you're losing like 10 grand at a time. It's not even like a little bit, it's like huge chunks of money that you're losing after month after 2 months. So
Well, and then what about the sellers who don't want to fix anything? Because I feel like the houses that are, they paint or maybe do the repairs needed, those sell faster because they have more appeal than the ones that are fixer uppers right now. What do you
mhm.
think?
Yeah, definitely for sure. If someone walks in, because they're paying a premium, it's like, I'm going to pay, the average house is 500K. I'm going to pay what, 3,200 a month or so, 3,000 a month. And you know, it needs work. Like people aren't going to do that. They're just going to wait
Yeah.
or do,
Whereas before it was kind of like they could sell it at a high price and not do anything to it.
yeah.
And it's like that's not the mindset anymore.
And what's crazy is that was such a small time frame. It was such an anomaly, but people are so attached. I'm attached to it. I'm like, oh God, I love that, where we could just sell a
Yeah.
house quickly and not have to get multiple offers. That was a very rare short time, and it's likely not going to happen again unless there's some another catastrophic
Well,
black swan
that
event.
that's what people they always want to wait for. They're like hoping that the rates when they drop that they're going to go into the twos and threes again, and that's highly, highly, highly unlikely for it to ever happen again for the same reasons. So, um, yeah, I don't know. Everyone just is stuck in that mindset because it was a really unique time, and some people got really good deals and they got a lot of money, and I don't know if that's going to be a thing.
Well, with a 3% interest rate, you can afford to put in an extra $200 a month towards
Hmm.
fixing the things yourself. But it's just it's amazing how much paint and carpet it goes so far to just do a couple things and fix things that are pretty obvious, because it gives the impression that the house was taken care of, that there's not going to be a whole lot of issues, because when you walk into a house there's all kinds of stuff that's wrong, the buyer's automatically thinking like, oh well, they didn't take care of this house, I'm going to have to, it's a money pit, things like that.
Well, and then for me as a consumer, when I walk into houses like that, I just think like, oh man, like how much time am I going to have to invest into this? And I'm going to have to fix things up. And I just don't want to do that. So,
Which is funny to me, because I feel like I'm like, ooh, this is an opportunity to get a good deal.
yeah,
Like,
see, different mindsets.
yeah, I'm like, this
Like,
house needs carpet. Well,
yeah.
my first house, I walked into like 20 grand equity just because the garage smelled like they had dogs living in the
Mhm.
garage, and it smelled like you couldn't breathe. And then the walls were painted red, and I'm like, okay, so you spend a few $100 on paint, we can get the smell up, no problem. And like for me, that was a huge opportunity, and it worked out for us. But
Yeah.
I know a lot of people want move-in ready. If they're going to be spending that kind of money, they want move-in ready. So I guess it's
Yeah,
just,
yeah, and I'm like move-in ready-ish. Like I can see potential and I don't mind doing like some things, but whenever you're looking at big projects, I'm like, you know,
yeah.
it's not for me.
Yeah. Um, so the other question I had, let me see if I can find it. I think we hit them all. Did we? So we talked about what is an arm, right? Maybe some people don't know what an arm is. You got the younger buyers.
Younger. Yeah. So it stands for adjustable rate mortgage. So essentially it is just what it is. The interest rate can and will adjust depending on what is going on with the market at the time when the loan balloons. So what that means is that, well, I guess I'll say like what I said before. There's different arm types and there's different terms. So one that we have is a 7/6. Like I said before, seven, the beginning number means that it is fixed rate for the 7 years. And then the six means that it can adjust every 6 months after that. And then there's, terms in between there. But that's essentially what it is. So ballooning would mean the 7 year period is over, it balloons, and then turns into the adjustable rate mortgage for this every
Okay.
6 months.
So if we were to whiteboard this out, like what would that look like? So how does it work? Someone comes in and they say, let's just go based off your most popular term. And the term
Hmm.
is just basically the product itself, the loan product.
Hmm.
So your most popular one, would you say that's a 7? Because you've
Well, I mean, now it
let's
just
just
depends on
go
what
off the
someone.
7
Yeah,
because you said it a
we'll just go
couple
off
of
this time. I
times.
said it a couple times. That's just because that's the one I worked on this morning, so it's fresh in my head.
Okay.
But
So I'm like, Randy, I want to buy this house. What's your 7-year arm look like? How much do I have to,
So
what does that look
normally,
like?
what happens is somebody comes in and they want to just see what they're qualifying for. And everybody thinks in their head, I want a conventional mortgage. Okay, great. So we do the application, we see what the conventional mortgage looks like. And then I usually just throw out there like, hey, here's what the conventional is. This is what the rate would be for this. Or if you're a first time home buyer, this is the first time home buyer program conventional rate. But we also have these arm loan options. And then I'll go into explaining what the arm loan is, how that works. And here's the interest rate, here's the terms of it, and here's what it looks like. And I give them both options to see, to really see what the differences would be in payment and how much they would be saving over those couple years. And that's basically how it usually starts. I would say none of the people who came in to qualify came in asking for an arm loan. It's
Mm.
more once they see the differences in payment and what they could afford at when they do the arm loan, that's when they decide to to go that route. So, but it's normally just starting off conventional.
Okay. And then year one, it's this much per month for the first year. And then the
Yeah, and
second
it'll
year.
stay fixed that way for 7 years. So it'll say this is your fixed rate for that 7 years, and then it
That's
can.
crazy because it
Yeah.
sounds way more complex and it has such a negative connotation, but it sounds like I want to do home loan.
It's really not as bad as it seems. And like I said, they just have a bad rap because of what happened before, because there were some not so great things that happened, and there weren't rules and regulations in place. And now we have tons of rules and
Yeah.
regulations, and I mean, it's ever changing. So it's they're not they're not putting themselves into a really terrible situation as they were in the past.
Okay. Cool.
Yeah.
Is there
So
anything else that you want to add?
I don't think so. I'm looking at my little checklist here, and I think we touched on pretty much everything.
Okay. Well, if you, what states are you licensed in again?
So I'm in just Colorado right now.
Okay. So if
Yeah.
you're looking for a house in Colorado, well, anywhere really, I can help you find a realtor. But if you are in Colorado and you need a loan, Randy can help you with that, with
Yeah.
consumables,
We will
arms, all the above.
hopefully be in more states here soon, but as of right now, just Colorado.
Okay, cool. Well, thank you. I appreciate you. And we'll be back. I'm not sure when, but I think we do get it when we set up, which I didn't know this last time, but when we set up the appointment, it automatically sends notifications out of that we're scheduling a live. So, and then last week we had to reschedule because we needed to go eat tacos. There's a
Hey,
new restaurant.
it was good. I was happy about it.
Yeah, it's called La Patrona and it's on North Academy. If you haven't been there, try it. Check it out. It's pretty good. So, anyway, we'll see you guys next time. Just keep an eye out, subscribe, and all the things.
All right. See you later.
Bye.
Bye.